A couple in their early 30s sits at a kitchen table with a laptop open. They're not doing anything dramatic. They're just running numbers. They make a combined income that would have sounded impressive 20 years ago. No debt they're ashamed of. No bad decisions they're hiding from. They've been saving for 4 years. They open a mortgage calculator. They type in a house they found online. A normal house. 3 bedrooms, nothing fancy, the kind of place their parents would have called a starter home. The number that comes back doesn't match what they expected. It doesn't even come close. They check it again, thinking they made a mistake. They didn't. And here's the part that actually stings. It's not that the house is unusual. It's that the house is completely ordinary, which means the math they're looking at isn't a personal problem. It's everyone's problem now. Introduction: if you felt like buying a home went from difficult to almost impossible in what feels like no time at all, you're not imagining it. And you're not alone in feeling it. But here's what most explanations get wrong. They tell you homes are expensive. You already know that. What they don't tell you is why, specifically, in a way you could actually explain to someone else at dinner. That's what this is. Not another video telling you the obvious. A breakdown of the actual mechanics. What changed, when it changed, and which piece of this is hitting your situation the hardest. Because once you can see the individual pieces, the whole picture makes a lot more sense. And it stops feeling like something you did wrong. We're going to walk through 7 separate shifts. Some of them you've heard of, a couple of them you probably haven't. By the end, you'll understand why this didn't happen overnight, and why it's not going to fix itself overnight either. Chapter 1. The math that used to work start with a simple question. What did a house actually cost a normal family compared to what they earned? For most of the last century, there was a rough rule people didn't even have to think about. As recently as the year 2000, 2 out of every 3 major American housing markets had a home price sitting below 3 times the local median income. According to research from Harvard's Joint Center for Housing Studies, a home costs somewhere around 2 to 3 times what a family made in a year. That ratio is the whole story in one number. If you made a decent living, a house was reachable. Not easy, not free, but reachable within a normal number of working years. Today, that ratio looks completely different. In 2022, the Joint Center for Housing Studies found the national price-to-income ratio had climbed to a record 5.6, the highest figure on record dating back to the early 1970s, and it has stayed elevated in the years since. Think about what that actually means in practice. It's not that homes got twice as nice. It's that the same house now takes twice as long or longer to reach. Now here's a piece almost nobody mentions. It's not just that houses got more expensive. It's that a specific type of house has been quietly disappearing. Builders used to make real money on small, no-frills homes, the kind a young couple could actually afford as a first purchase. According to Freddie Mac's own research, single-family homes under 100 square feet made up more than a third of all new homes built in 1976. By 2020, that share had collapsed to around 7%. It's ticked back up slightly since, but new small homes still remain a small fraction of what gets built. Builders didn't stop building houses. They mostly stopped building that house, because the profit margin on a bigger, more expensive home is simply better. So imagine being a first-time buyer today. You're not just competing against higher prices. You're shopping in a market where the entry-level product you're actually looking for makes up a shrinking slice of what's even for sale. So the first thing that changed isn't a mystery or a conspiracy. It's a math relationship that quietly broke, and a category of housing that quietly thinned out at the exact moment more people needed it. And once those two things break at the same time, everything downstream of them breaks too, which raises the next obvious question. If incomes didn't collapse, what actually moved? Chapter 2. The interest rate trap. Here's something most people don't think about until they're the ones filling out the paperwork. The price tag on a house is only half the story. The other half is what it costs you every single month to borrow the money. And that number is driven by one thing most buyers never paid attention to before they needed a mortgage: the interest rate. For years, rates sat low enough that people barely thought about them. In 2021, Freddie Mac recorded the average 30-year mortgage rate at just under 3%, one of the lowest readings in the survey's history. A low rate meant your monthly payment was manageable even if the price of the house crept up. It was quiet, invisible math working in your favor. Then rates moved, not gradually, sharply. By October of 2022, the average 30-year rate had climbed above 7%, according to Freddie Mac's weekly survey. Rates have eased somewhat since, but as of the middle of 2026, they're still sitting in the mid-6% range. Here's what that actually does to a family's budget. Take the exact same house, the exact same price, and just change the interest rate from under 3% to over 7%. The monthly payment can jump by hundreds of dollars, sometimes close to $1,000. Same house, same neighborhood, same size family, a completely different monthly bill, based entirely on when you happen to buy. That's the part that feels unfair to people. And honestly, it kind of is. Two families, identical in every way except timing, end up living completely different financial lives because of a number set by forces that have nothing to do with either of them. Now think about the family on the other side of that math, the ones who already own a home and locked in a rate years ago. For them, moving isn't just inconvenient anymore, it's financially irrational. Research from the Federal Housing Finance Agency found that roughly 60% of homeowners with a mortgage today are sitting on a rate below 4% because they bought or refinanced before the pandemic-era rate hikes. Selling their current home means giving up that rate and taking on a new one at today's numbers, even if the new house isn't any bigger or nicer. So a lot of them simply don't move. The same FHFA research estimates this lock-in effect prevented roughly 1.7 million home sales between 2022 and 2024 alone, and pushed home prices up by an additional 7% in the process, simply because so much less inventory hit the market. That single decision, multiplied across millions of households, does something quiet but powerful. It keeps homes that would normally turn over, empty nesters downsizing, growing families upgrading, sitting exactly where they are. Fewer homes hit the market, the ones that do get fought over even harder. And for someone buying their very first home with no old rate to protect, there's a psychological layer to all of this too. A 2025 Bankrate survey found that more than half of current homeowners said they wouldn't feel comfortable buying a home at all in today's rate environment, and most of those who would consider it said rates would need to fall back below 5% first. There's no comfortable choice left in that decision, only a less uncomfortable one. So rates froze a huge number of people out and froze a huge number of existing owners in place at the same time. But here's the twist nobody expects. If ordinary families are getting priced out and existing owners aren't selling, who's actually still buying all these houses? Chapter 3. Who's actually buying the houses? Drive through a newer subdivision sometime and count the sold signs. A lot of those homes never sat empty, waiting for a family to save up a down payment. A growing share of homes, especially in certain markets, aren't being bought by people who plan to live in them at all. They're being bought by companies, investment firms, groups that buy houses the way other people buy stock, as an asset that generates return. Redfin's most recent analysis puts real estate investors at roughly 18% of all U.S. home purchases in 2025, a share that's held essentially steady from the year before. That's not illegal, that's not a scandal. It's a completely rational financial decision for the buyer. Houses have become a genuinely good investment, which means investors show up to compete for them, exactly like they would for any other asset that reliably goes up in value. But here's the problem that creates for everyone else. A regular family has to save for a down payment, get approved, wait weeks to close. An investor with cash and a fund behind them can move in days, often without needing a mortgage approval at all. According to Redfin, investors paid in cash for roughly 62% of their purchases in 2024. A cash offer skips the appraisal contingency, skips the financing contingency, and lands on a seller's desk looking simpler and safer than a young family's offer, even if the family is offering the exact same price. Picture the bidding war that creates. A 3-bedroom house gets listed on a Friday. By Monday, there are a dozen offers. Several of them are cash, several are above asking, and at least one is from a buyer who's never going to set foot in the house because it's going straight onto a rental listing the following week. The family who wanted it to actually live in isn't just competing on price anymore. They're competing on speed, certainty, and paperwork they can't match. This isn't happening evenly across the country either. In West Palm Beach, Florida, nearly half of all home purchases in 2024 were made entirely in cash, according to Redfin. In coastal markets like San Jose, that figure was closer to 1 in 5, which means, depending entirely on where a family happens to be looking, they might be facing a handful of competing buyers, or a market where cash offers are simply the norm. It's not a fair fight. It was never designed to be a fight in the first place. Regular buyers and institutional buyers aren't playing the same game, even though they're bidding on the same houses, which brings up something that should be an obvious fix. If demand is this high, why hasn't the market just built more homes to meet it? Chapter 4. Why nobody's building enough homes. This is the part of the story that barely gets mentioned, and it might be the most important piece of all. For years, the country simply hasn't built enough new homes to keep up with how many new households are forming. Freddie Mac's economists put the current national housing shortfall at roughly 3.7 million units, and the National Association of Realtors, using a different methodology based on construction rates since 2000, estimates the gap could be as high as 5.5 million. Why not? A few things are stacked on top of each other. Start with zoning. According to research cited by the Brookings Institution and confirmed by a widely cited New York Times analysis, roughly 75% of residential land in major American cities is zoned exclusively for detached single-family homes. That sounds technical, but it has a very real effect. It makes it nearly impossible to build smaller, cheaper starter homes at scale, even in places desperate for them. Then there's the permitting process itself. Getting approval to build isn't a quick stamp of paper anymore in a lot of jurisdictions. Industry data compiled by the National Association of Home Builders shows permitting timelines that range from a few weeks in simpler jurisdictions to 6 months or longer in others, with complex projects sometimes stretching past a year. Every extra month of delay is a cost that eventually gets folded into the final price of the house. Add the labor side. The construction industry lost roughly 2 million workers during the 2008 recession, according to Associated General Contractors data, and huge numbers of tradespeople never came back. The industry never fully replaced them. Today, the average construction worker is over 42 years old, and nearly a quarter of the workforce is over 55 and approaching retirement, which means even when demand for new homes is high, there simply aren't enough hands to build them quickly. Then materials, labor costs, and land itself have all gotten more expensive at the same time. Put all of that together, and here's the decision a builder actually faces. Build a smaller, cheaper home and barely clear a profit after all these rising costs, or build a bigger, more expensive home where the same fixed costs are spread across a higher sale price. Almost every builder, given that choice, picks the second option. Not because they're greedy, because the math of the first option barely works anymore. So picture what that does over 10 or 15 years. Every year, hundreds of thousands more families need somewhere to live than there are new homes built to house them. That gap doesn't disappear. It stacks. Year after year, it just keeps compounding. And when supply can't keep up with demand, prices don't gently rise. They get pulled upward by every single buyer, competing for a shrinking slice of what's actually available. So even if rates came down tomorrow, even if investors backed off completely, there's still a structural shortage underneath all of it that neither of those things would fix on its own. Now here's where it gets even harder for the families who do manage to buy, because the price tag was never the whole bill. Chapter 5. The hidden costs nobody warns you about. Say a family finally does it. They save enough, they qualify, they close on a house. You'd think the hard part is over. It isn't, because owning a home comes with a second layer of costs that barely existed as a serious problem a decade ago, and now quietly eat away at what people thought was a fixed, predictable monthly payment. Start with insurance. According to a 2025 report from the Consumer Federation of America, the average homeowner's insurance premium rose by roughly 24% between 2021 and 2024, an increase of about $648 a year, pushing the typical annual premium to $303. Premiums rose in 95% of zip codes nationwide, and in some high-risk regions, federal watchdog research from the Government Accountability Office found premiums climbing 25% or more, with some insurers pulling out of the riskiest areas entirely and leaving families scrambling for coverage at all. Imagine budgeting carefully for a mortgage payment, locking it in, feeling secure, and then getting a renewal notice a year later showing the insurance line alone has gone up by several $100s, with no warning and no way to negotiate it. Then property taxes, which climb right alongside rising home values, meaning the same house can cost meaningfully more to simply keep year after year, even if the mortgage payment itself never changes. Nationwide, property tax bills rose by nearly 30% between 2019 and 2024, according to Redfin's analysis of the 50 largest metro areas, pushing the median monthly property tax payment to around $250. In some fast-appreciating markets, a home's assessed value can climb so quickly that long-time owners, especially retirees on a fixed income, end up owing property taxes that rise faster than their actual income does. Add in HOA fees where they apply, which have also been climbing as aging infrastructure in older developments needs more expensive repairs. Add maintenance that never stops needing attention. And in some regions, the very real risk of climate-related repricing on top of everything else. Homes in flood zones or wildfire-prone areas increasingly facing either sky-high premiums or no private insurance option at all. Here's the part that really gets people. A family can do everything right, lock in a rate, buy something reasonable, budget carefully, and still watch their actual monthly cost of owning that home creep upward year after year through costs that have nothing to do with the mortgage at all. Two households with the exact same mortgage payment in two different states can end up with total monthly housing costs hundreds of dollars apart, purely because of what insurance and property taxes look like where they live. The price tag was never the real number. The real number is what it costs to keep the house every single year for as long as you own it. So with all of this working against ordinary buyers, is there anywhere left in the country where the math still makes sense? Chapter 6. The places still working. And why? Here's some good news, because this story isn't the same everywhere. There are still parts of the country where the price-to-income math looks a lot closer to what it used to be. places where new construction hasn't hit the same walls, where zoning is more flexible, where investor competition is lighter, and where a normal income can still realistically buy a normal home. That's not a coincidence, and it's a big part of why you've probably noticed people moving, entire families relocating states, sometimes regions, chasing exactly this math. Census Bureau estimates show Idaho, Florida, and Texas among the fastest-growing states in the country since 2020, each expanding by roughly 9 to 10%, driven in large part by domestic migration from more expensive states. Meanwhile, look at the places losing residents, and a pattern shows up on the other side too. Since 2020, California's population has declined by more than 200,000 people, and New York's by more than 200,000 as well, according to Census Bureau data, among the largest losses of any states in the country. Census figures also show California has lost more residents to Texas than to any other state, people trading a higher-paying job in an unaffordable city for a lower-paying job somewhere the math actually closes. It's worth being honest about what that actually means, though. It's not really a solution to the national problem. It's people finding a workaround for their personal situation, one household at a time, while the underlying structural issues stay exactly the same everywhere else. And it comes with its own quiet cost, leaving behind a job, a support network, sometimes an entire community, just to make the housing math work. But it does tell you something important. This isn't some unstoppable law of nature. The places where the math still works prove that the conditions causing this crisis are specific, identifiable, and in some places simply haven't happened yet, which means the real question isn't whether home ownership is dead everywhere. It's what all of this actually adds up to for the country as a whole. Chapter 7. What this actually means. Going forward, so put it all together for a second. Home prices grew faster than incomes for years, while the entry-level homes people actually needed quietly became a smaller share of what got built. Interest rates then made the exact same house cost far more every month than it used to, and froze existing owners in place at the same time. Investors started competing directly with ordinary families for the same limited supply, often winning simply because they could move faster. Builders couldn't or wouldn't build enough new homes to close that gap, held back by zoning, permitting delays, and a shrinking skilled workforce. And even the families who do manage to buy are facing a second wave of rising costs just to hold on to what they bought. None of these forces are a secret conspiracy. Every single one of them, on its own, has a completely rational explanation behind it. But they didn't happen one at a time. They happened together, stacked on top of each other, hitting the exact same generation of buyers all at once. And that's showing up in ways that go beyond just delayed home purchases. According to the National Association of Realtors' most recent survey, the median age of a first-time homebuyer climbed to 40 years old in 2025, an all-time high, up from just 28 in the early 1990s. First-time buyers now make up only about 21% of the market, the lowest share on record since NAR began tracking this in 1981. That delay doesn't stay contained to housing either. Starting a family, saving for retirement, building the kind of home equity that used to anchor a household's long-term financial security, all of it gets pushed back when the first big purchase of adult life takes years longer to reach. There's a wealth gap building underneath all of this too. The Federal Reserve's survey of consumer finances found that in 2022, the median homeowner household had a net worth of roughly $396,500. The median renter household had just $10,400, a gap of nearly 38 to 1, and one that has been widening for decades. When an entire generation buys later, or not at all, they're not just missing out on a house, they're missing out on decades of equity growth that their parents' generation had a head start on, which means the gap between homeowners and renters isn't just about where people sleep at night. It's becoming a gap in long-term financial security. That's the actual answer to the question this whole video set out to answer. Home ownership didn't become unreachable because people got lazier or worse with money or less deserving than their parents were. It became unreachable because 5 or 6 separate systems all shifted in the same direction at the same time without anyone coordinating it and without anyone really announcing it. And once you can see all 5 of those pieces clearly, something interesting happens. The whole situation stops feeling like a personal failure and starts looking like exactly what it is: a shift in the rules. While most people were still playing by the old ones. Go back to that couple at the kitchen table for a second. They're not going to close that laptop and suddenly qualify for a different mortgage. Nothing in this video changes their monthly payment, but there's a real difference between feeling priced out and understanding exactly why. Once you know which piece of this is actually working against you, the rate, the competition, the supply, the hidden costs, or some combination of all 4, you can actually plan around it instead of just feeling stuck by it. That's the practical part. Know your specific number, know which pressure is pushing it, and you can make a real decision instead of a guess. This was never really a story about houses. It's a story about what happens when a handful of separate, reasonable decisions quietly add up to something nobody actually chose. And that's exactly the kind of thing worth understanding about the rest of the American economy too, because housing isn't the only place it's happening. If this helped you see the picture more clearly, that's exactly what this channel is here for. We'll keep breaking down what's actually changing, one piece at a time.